In India, gold functions as the primary multi-generational financial safety net. Families quietly accumulate jewelry and coins to protect their wealth against inflation and economic emergencies. It is a deeply ingrained cultural habit that operates as a private insurance policy. By 2015, this private safety net became a macroeconomic crisis. Massive gold imports were draining India's foreign exchange reserves and weakening the national currency. To stabilize the economy, the government had to find a way to satisfy the cultural hunger for gold without actually importing the physical metal. In November 2015, the Ministry of Finance and the RBI launched the Sovereign Gold Bond Scheme as a direct alternative to physical ownership. The deal was simple. Citizens could buy paper gold that tracked the market price. The government offered a 2.5% annual interest rate, removed the need for bank lockers, and backed every gram with a sovereign guarantee. This official notification details the specific terms of the deal. Clause 17 is the most critical. It states that the government will not hedge the deposit and will bear all risks associated with gold price and currency fluctuations. The rollout was an immediate success. Over the next decade, the government raised 72,274 crore rupees from millions of investors across 67 different tranches. On paper, the policy achieved its goals. It formalized household savings and stopped the drain on foreign exchange. This strategy relied on an implicit assumption that gold prices would remain stable. Instead, the market entered a historic bull run. In 2015, the government borrowed at an average price of roughly 2,600 rupees per gram. By mid-2026, the price of that same gram reached 14,400 rupees. This surge transformed the scale of the debt. The 72,000 crore rupees originally raised has ballooned into an estimated 1.87 lakh crore rupee liability. This creates a gap of more than 114,000 crore rupees, a fiscal burden generated entirely by the rising price of the asset they promised to repay. Despite the scale of this nearly 2 lakh crore rupee liability, it has not triggered a significant debate within the national budget. India's accounting standards follow a cash basis system. This means market-linked debts are recorded only at their historical issue price. The actual cost of redemption remains invisible in official accounts until the day the money is actually paid. To manage this, the government created the Gold Reserve Fund, a dedicated safety pool designed to absorb price risks and fund redemptions. However, the fund is critically under-provisioned. It currently holds just 697 crore rupees to cover a liability of 1.87 lakh crore. This is a coverage ratio of less than 0.4%. While the government remains technically compliant with accounting laws, it is sitting on a structurally underfunded and largely hidden financial obligation. This table lists the top 10 countries by official gold holdings. It confirms a global trend. Central banks are hoarding gold at the highest rates in half a century. China is the primary driver of this trend. The People's Bank of China purchased 225 tons in 2023 alone, prioritizing strategic accumulation. In February 2022, Western nations froze $300 billion of Russia's central bank assets held in foreign institutions. This event proved that dollar assets held offshore can be seized, whereas domestic physical gold remains under a nation's direct control. Global trade is now shifting from the paper gold system in London to physical delivery at the Shanghai Gold Exchange. Because the SGE requires actual metal for every trade, and major buyers are now purchasing gold regardless of the price, the scarcity of physical metal is being priced directly into the market. This structural shift prevents prices from returning to the lower levels seen when India's bond scheme began. India designed its bond scheme for a stable financial world that is quickly disappearing. By promising to pay investors in gold rather than holding the metal itself, the government has effectively shorted the very asset that global superpowers are now cornering. While the government owes gold, the Reserve Bank of India is actually accumulating it, increasing its domestic holdings to over 880 tons. This creates a strange accounting loop. As gold prices rise, the RBI's reserves gain value, allowing the bank to book a profit and transfer a larger dividend to the government. The same price surge that increases the bond debt also inflates the revenue used to hide the problem. This dividend makes the current fiscal deficit look manageable, creating a false sense of security in the national budget. But these revaluation gains are not guaranteed. If the dividends stop, the debt to millions of bondholders remains. The sovereign gold bond scheme was a well-intentioned policy that reduced physical imports, but it ultimately collided with a global shift toward physical gold security. As the major redemption wave approaches between 2027 and 2032, the government must find a way to bridge the 2 lakh crore rupee gap. Every public policy carries a specific price tag. For India's golden gamble, the bill is due.